Welcome once again to the 25th Annual REIT Symposium at the NYU Schack Institute of Real Estate. I'm Sam Chandan, the Larry and Clara Silverstein Chair in Real Estate Development and Investment at the Schack Institute, as well as the Institute's Dean. It is my great privilege to once again this year welcome our honored guest, Sam Zell. Sam, thank you so much for joining us.
It's a pleasure, as always. I think this is something like 20 some odd years.
That's right. I was speaking to a couple of the folks, Robin Panovka and Adam Emmerich, who've been involved with the conference really since its beginning. And I have to say, on behalf of the students and faculty and everyone over here at NYU, just how thankful we are for your support. I believe you've been here with us 25 years in a row.
Yeah, something like that.
I know you're a great supporter of academic institutions. So there's generations of students and young alumni out there who are deeply grateful for it. Sam, we've had an extraordinary year. I know that you've been going into the office the entire time. And one of the questions I'm going to ask you about is your expectations for how cities like Chicago and New York, where there's still a raging debate around the role of the office and going back to work, where you see that resolving over the course of the next 6 or 7 months. Before we talk about the real estate, I do want to begin with a discussion of the broader economy. It appears as though we are on track for a robust recovery. The rapid deployment of the vaccine, certainly seems to be supporting that thesis and that trend. What are your expectations for how the economy will perform, this year and over the next couple of years?
Well, the metaphor I think about is a coiled, hand, or it's where my sense is that the impact of being in place for the last year, I think is very significant, and I think that when we reach, whatever it is, 60-70% vaccinated, I would expect a very positive subsequent 12 months. Obviously, assisted by the largesse of what they called the COVID recovery bill, which was really a small amount of COVID and an awful lot of everything else.
Yeah, so I do want that's actually my next question. With regard to the government's largesse in its most recent round of support for the economy. As an economist, I see that there are some parts of the intervention that are clearly targeted towards people and small businesses, others who have been directly impacted by the pandemic. But there's also a lot there that looks like it's entirely unrelated to pandemic response. What is your sense of how helpful, how targeted, how broad it's been? And as well, when we're thinking about sort of that next round that might be around the corner, what should some of our priorities be there in terms of either scaling it back or are there areas for support that we've missed?
Yeah, I do not support the $1.9 trillion bill. I think that it is more than double the size that would be required. I think it materially reduces options going forward. It's used a lot of bullets to, I think, going to fuel the stock market more than it's going to fuel poverty. I think that to the extent that we were out to reduce poverty, to reduce the impact of COVID, I'm all for that, and I think that by almost any historical standards, running extra deficit to respond directly to a problem has always been acceptable. I mean, the borrowing rates during World War I and World War II were staggering, but there was an objective and there was an end in sight. What I I'm very disturbed by the fact that I think we're, subsidizing an awful lot of different interests that have nothing to do with COVID and ought to be done with true legislation that addresses the questions. I'm also concerned about the level of debt. I mean, we've been on a debt issuing binge that's really frightening, and and we've only been able to afford it because we've artificially kept interest rates low and therefore be able to make debt service payments. But if you think about the fact that for the last, 40 years, the average risk-free rate was 5.6%. And we now have a risk-free rate of 1.5 for, I'm not sure what it is, but somewhere around there. If we were to, revert to the mean, we wouldn't have any chance of being able to service the debt we've been creating. And I'm concerned about the fact that, I don't see a plan to solve or address the problem. And ultimately, we're putting the reserve currency status of the US dollar at risk. And of all the times in history where I think, putting that at risk is maybe not a great idea, this would certainly be one of them.
Yeah, so you've raised a couple of important points that I want to come back to. The first, where you said that the size of the stimulus, how significant the intervention has been, has reduced some of our options. Could you just elaborate on what you mean by that?
Well, we can only make assumptions of, what's going to happen next. I think it's safe to say that the initial impact of, freeing things up, I think is likely to be very positive. What we don't know is what happens next. And, the unforeseen circumstances. To the extent that this stimulus bill were, 900 million, that meant that we would have another $1 billion, or another $1 trillion to work with going forward. Having spent this money the way we've spent it, I think, whether they want to admit it or not, each step of the way here is a limiting factor, and limits, how much or and what you can do in the future.
Yeah. So your point about, ultimately the bill coming due, there doesn't seem to be a lot of public discourse around the fact that one day we do have to actually pay all of this back. Part of the reason that it's supportable in the short or medium term is because of historically low rates. And I realize that we've got a whole generation of folks that maybe have entered the workforce, in the last decade, for whom rates, as they are today, don't seem historically low. It's just because they don't have the longevity in the market to know what sort of we were contending with in the 80s and 90s. What are the circumstances under which you see the potential for higher rates and a greater debt service burden for the country?
Well, I mean, higher rates are inflation reflects it. There's been a lot of discussion about, let's get the inflation rate up to 2, let's let it go a little further to make up for what we didn't do before. Man, they're treating inflation like, it's something on a chart that you can move back and forth at your own free will. We've had a very interesting experience in the last week with the Suez Canal blocked, and what that does, and there's been an enormous cost to that, to a world economy. Where does it show up as? I assure you, it's going to get paid. The question is, where does it show up? So I think there's a certain naivety about the fact that it's controllable. I was around when Volcker was pushing interest rates to 20%. I was, I remember vividly, closing a loan with an insurance company in 1977, and the loan was for 30 years at 7.75%, and the same day the CPI was up 13.35. So and I assure you that if we could have controlled it, we would have. But I think that that's really the risk here.
Yeah, no, I think sort of as an economist, again, sort of we're probably a little bit overly optimistic, let's say, in our thinking about our ability to control inflation.
Or maybe the word naive is more correct.
Okay. One of the other things you mentioned is the potential loss of reserve currency status for the United States. Some folks will say there's no good alternative. Are you talking about a world where we don't have a reserve currency, or where it's rebalanced, and where we've got Renminbi and the euro playing a more significant role as quasi-reserve currencies?
Well, I can't. I don't know how to answer your question, but I'd start out by saying that at the end of World War II, the very first thing that we addressed was the question of, parity of currencies and relationship of currencies. And I think that ultimately, contributes to the stability of the world. And yet we're seeing, as an example, that Saudi Arabia is selling oil to China for the yuan. Russia is selling gas and oil to China for the yuan. The yuan is not a freely convertible currency. So in effect, are you taking the risk of sending the world into a structure that where you're giving any one country pretty extraordinary powers if you're accepting the fact that they're not producing a freely convertible currency? That's what price discovery is all about.
Yeah. So it does sort of point to our needing to be very cautious in our thinking about how we take our next steps. In looking at the policy debate in DC, it does seem as though there's an even larger set of spending packages right around the corner. What would be your advice for the politics of it aside? But what would be your advice for policymakers? Is the next step not to take one at all, or to potentially do something that again is very targeted to say who has been, what income constrained families, what types of businesses have been most significantly impacted by the pandemic, and targeted support for them?
Well, I'm a big fan of targeted support. What and how and where, I think, is a matter of conversation. The scale and the coverage of things that have been laid out as on the agenda, I think, are way too ambitious. Reflect, levels of government interference in the economy that I don't think we want to do. And I think that we need to slow this train down. And that doesn't mean that some of these things shouldn't be done. But I think that the execution risk is as great as the policy risk. And therefore, I would be an advocate of slowing the process down. You've passed this $900 million bill. Let's make sure it gets spent and spent correctly. And that was one of the great disappointments about the Pelosi stimulus bill in 2008. if we had really gotten $1 billion of stimulus, I think that history would have been very different. But in fact, we passed a bill that cost $1 trillion, but we didn't get the stimulus.
You've always got an eye on what's happening in other large economies around the world. Are there any right now that really stand out for you? Brazil, Russia, India, that are poised to significantly out or underperform?
No, I don't think so. I think that the world is, from a printing press perspective, everybody is printing a lot of paper. That means that you're on a moment to moment increasing the degree of trust that everybody has to have in their governments at a time when I think the example of who our governments are is not very good on any level.
Yeah. So let's dial right back. We spent a moment looking abroad, coming back home. I think one of my concerns being in New York City has been, what are some of the things we need to do at the local level, and at the state level to really help New York recover? You're in Chicago. What is your prognosis for some of the cities, some of the major urban centers around the country that have been so significantly impacted by the pandemic?
Well, I believe that the impact of the pandemic will be relatively minor going forward. I believe the most painful period will be the period from the time then people start coming back to the office to when it becomes a full-fledged, movement. I think we're social animals. I think this work from home concept was probably pretty terrific in the first month or two. Remember that you were working at home, you were working on Zoom with people you knew, people you trusted, people you had built up relationships with. And every day, those are becoming more distanted. And from an employer's point of view, I don't know how to motivate by modem. I don't know how you would promote people. A very small percentage of people have a work product that could be remotely assessed. Most assessment comes from observation and production. Take observation out of the equation, and pretty soon you don't know who your workforce is. So I think that getting everybody back to work is very, very important. I think that the process will probably be difficult and kind of operate in spurts rather than a nice, even scenario. I think there are going to be all kinds of adjustments that'll be made. I'm thinking about, one of these, high rises, very big buildings where, you have elevators that, go up a great distance, and that means you put an awful lot of people in an elevator together. Maybe you have to have more flexible hours, but I don't think that it is likely that we are transforming into some kind of a unique economy.
Yeah, and I do tell my students something along the same lines. And for young professionals, across our industry, being able to go into the office, meet people, collaborate in person, gives you the opportunity to build trust relationships, identify mentors, champions for yourself, to engage in cross-learning in a way that you just won't the quality of the relationship that you develop in person is just so different from what you're able to experience online. And so if you've just started in the industry, this is an even more important issue for you than it is for those of us who have been able to, as Sam described, have been able to fall back on long established relationships, at least for a brief period of time, before the quality of those relationships begins to slip a little bit.
It's like the shore and the waves. Every day that you're not here, the culture is eroding. And by the way, during that same period of time, I mean, we've hired a bunch of people in the last year. They don't have a chance. I mean, they need to interface with the people that they're going to be relying on, connecting relationships with, and trusting. And they're not going to be able to do that by Skype or by Zoom.
Yeah. So talk to me a little bit more about sort of a city like Chicago or New York. I know in New York, I mean, we're under some pressure to potentially raise taxes on the sort of our wealthiest residents and the ones that are the most mobile, and there's pressure to that at the state level as well. We're not a tax efficient state as it is. What are some of the things that mayors and governors need to be careful of when thinking about how to navigate to make to ensure our cities remain competitive?
Well, I'm a big fan of making our cities competitive. I think that what you just said is very true, that your wealthiest constituents are also your most mobile constituents. I think the number of people who've left New York and Connecticut and New Jersey because the tax equation was getting out of hand. It seems as though, and it's true for Illinois, it's true, taxing the rich seems to be, the current, fad, but they are mobile and they will adjust. And, so much of the assumptions are based on the fact that people act as they act because the rules are what they are. And to the extent the rules change, people will change how they act. And the impact will be to produce the lowest, government take, as is logical. And from my perspective, losing sight of that is very deleterious. I also think that, for places like New York and Chicago and San Francisco, the people who have the money are not taking, intern jobs at Goldman Sachs. So that group of people, let's say young people from 24 to 32 or 35, they're not really focused on the taxes. They're focused on having a great time. I mean, one of the greatest demographic changes in history has been the deferral of marriage. I mean, we've gone from roughly 20 to 30 in a generation. And what its impact has been on cities, what its impact has been on disposable income, only history will really tell, but I think it's been very significant. And those people are going to keep those cities going, because the idea of exiting yourself to your family's basement or exiting yourself to somewhere in Iowa, cost of living may be better. It may be better than New York is today, but not how it is tomorrow.
Right, and I have a lot of friends, and it's very anecdotal, who've picked up and might have moved to Florida at some point over the last year. I can't open the paper on any given day without reading about some company thinking about expanding or signing a big lease somewhere in the Southeast or in the Sun Belt. But I also, have a sense that some of my friends that have moved are experiencing a bit of buyer's remorse. And at some point soon are going to be making their way back home to New York City. What's your sense? Is there momentum around this southward migration?
Well, I'll give you two perspectives. One, I was in Miami last weekend, and the real estate market in Miami is just beyond hot. I mean, it's crazy. And it's particularly crazy at the upper end, where the customer is the New Yorker or the Northeasterner. On the other side of the coin, we own 20,000 apartments in the New York metropolitan area. And our average tenant is upper income, probably 40 years old. We suffered when the pandemic began. Occupancy went down, rate went down, concessions went up. Something happened in December. I think it's called a vaccine. And since December, occupancies have gone up, rates have gone up, concessions have gone down. And it's, the beginning to the end to the beginning is going to be expensive, but it looks like we're moving toward, the level of occupancy and a rate structure very similar to what it was before. So there's no question there's been, by the way, this almost identical thing has happened in San Francisco, where we have a very large presence, where the pandemic hit, prices went down, occupancy went down, and then literally starting in December, everything turned positive, and it's continued to be positive every month.
Yeah. So if people are going to go back to the office, and like you, I think it's going to be a bit of a challenge at first to get people back in, but ultimately, it's to our collective and individual benefit that we re-socialize ourselves. But as you also said, there will be some accommodations and reasonable adjustments made. We want to avoid overly congested public transportation, and so maybe we have more flexible hours where people begin and end their days. What are some of the changed behaviors that you expect will come out of the pandemic? Is it really the case that we go back to living the way that we did before COVID, or are there some real changes that we see emerge, whether it relates to how we go to work or how we live?
Well, I mean, let's just look at what happened last week when a bunch of Goldman Sachs interns petitioned management for some relief on the level of work that they're doing. Now, I didn't notice in their petition that they were also petitioning for lower pay.
Probably
not. There is some relationship between how hard somebody works and how much they get paid, and that will ultimately be the result of this. I mean, maybe they reached a point where they gotta hire 20% more people and lower the pay grade for 20%. I don't know. But I think there is a certain amount of millennials who might not want to work as much as their predecessors have. I think that it's likely that we're going to see, Fridays off for, or one day every 2 weeks or something where you work from home. To the extent that people want to do that, and frankly, to the extent that all of a sudden, they're involved in, significant business activity where they have to meet with people and have to deal with people, and working from home means that they've cut off 20% or some percentage of their face time with their partners or their bosses or their compatriots. So I think that there will start with much more quote unquote flexibility, and then it'll kind of follow where gravity follows. I mean, one of the questions people have asked me about is, well, geez, think about all of the wasted sales calls, where somebody gets on a plane and flies halfway across the country to sit across the table from somebody for an hour. Now we have Zoom. It's much better. And my prediction is that that's exactly the way it'll start. And then two guys or two girls will be competing for one contract. And one of them will say, if I got on a plane and I sat across from this guy, I got a better chance of getting the deal. And he goes and does it. Well, that's the last time anybody's going to use Zoom in replacement to one-on-one relationship. In the same manner, we got a huge convention business. Most of us think about the convention business as partying. The reality is there are all kinds of businesses that depend on being able to expose products to all of their constituency in one location rather than going around and calling on them. So there's a whole bunch of this kind of stuff that I think as soon as we're vaccinated, I think is gonna come back and come back strong. And a lot of companies, there are probably a lot of buyers who have quote unquote made adjustments and bought online versus working with somebody up front and vice versa. And I think that as soon as the prohibitions against that disappear, I think we're much more likely to go back to where we were.
So with the few minutes we have left, I want to ask for your prognosis about some of the specific property types. Before we do that, I do want to say to the students and young professionals watching this, I know that over the last year, there's been a lot of pressure on a lot of people, and work-life balance has sometimes been really difficult, to maintain. Do take care of yourself, and know that everyone in the industry, all of us who are working as professionals, are here to support you and are thinking about your health and well-being. So do keep that a priority. We're thinking about you and wanting you to be well. Sam, what is your prognosis? What are you thinking about in terms of where the opportunities are, with the core commercial real estate property types over the next couple of years?
I think that, one of the impacts of the COVID thing has been a lack of price discovery. The number of transactions in the commercial real estate world has significantly reduced. To some extent, it's fear of, you wouldn't want to put a hotel on the market right now. One very fancy hotel here in Chicago went on the market and sold at 30 cents on the dollar. And it was a couple of years old. So that doesn't ring true that there's a whole bunch of people screaming, despite the fact that they've raised capital for workout things. I think so far, the banks have not been willing to take real steps to gain control. And to the extent that CMBS has been involved, at least so far, it's been very slow. So quote unquote, everybody's kind of waiting until there's quote herd immunity, and then find out, gee, our foreigners going to come back and and be part of the 60 million people that came to New York City for Broadway. How soon are we going to get Broadway back? So I think that there's a lot of hesitancy in transactions predicated upon exactly the question you asked me, which is, what's it going to be like?
Yeah, the industrial is everyone's favorite, property
Absolutely.
type right now. Overdone, overinvested? Is there still upside there?
I think there probably still is. I think that the scale of conversion of online business from 2026 and 27 to 2020 and 21 is creating a significant demand for industrial and distribution space that's likely to keep right on going. As far as office is concerned, all this discussion about office, it obfuscates the fact that we have a significant oversupply of office space in America. That's assuming there was no COVID. Add COVID to the equation, and that level is pretty significant. I mean, here in Chicago, it's pushing 20%. Probably is the same thing in New York and everywhere else. And to some extent, this is a function of the fact that this office sharing concept moved forward the leasing of millions and millions of square feet, which, quote, signaled it was time to build more. And we got 5, 6 million, 7 million square feet of brand new space in Chicago, not an equivalent amount of demand. So multifamily, I think, is going to be fine. Mobile home parks are going to be fine. Specialists like, digital real estate investment trusts and the towers, I think is really not a real estate play. It's really an economic play. And but nonetheless, I think that they're going to do very well. Now then, that comes down to retail. Now, I still think retail is a falling knife, and I think that what we've had so far, instead of a liquidation, is a series of bankruptcies, and the next step is going to be liquidation. And when that starts to happen, which I think is probably in the next 6 or 8 months, I think we're likely to start really having price discovery. There's an awful lot of overpriced retail.
Last question for you before we break. Everyone has a SPAC. Too many?
Well, I have one.
Okay.
And my guess is that usually when everyone has something, there's too many. It's hard, I think it's not what I thought it was going to be when we first started, and yet on the other hand, it's probably, considering how much the number of public companies has shrunk over the last 20 years, maybe this is just a re-sowing of the seeds in a different fashion.
Sam, it is, as always, such a pleasure talking to you. Again, on behalf of all of the faculty, students, and members of the Schack community, thank you for your continued support of the institution. You've been very generous with your time, and it is, as always, wonderful to see you.
Real pleasure. Thank you. Good luck.